In today's show, I'm going to share with you 5 property market predictions that I guarantee are going to happen in 2019. And then I'm going to have a chat with property researcher John Lindeman, and he's going to explain why the next housing boom may not be that far away. And that's going to be good news for you if you're interested in property investment. And I'm, of course, going to share with you my regular mindset moment. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the 5th time he's won a similar award in the last 7 years.
Well, we're 3 weeks into the year, and 2019 has already brought lots of interesting predictions and forecasts for property. Today, I'm going to give you my share. I'm going to give you 5 market predictions that I guarantee are going to happen in 2019. Now, let me give a little disclaimer. I'm actually away in Europe on a 7-week vacation, and I pre-recorded this show before Christmas. But still, I guarantee the predictions that I'm going to share with you today are going to come true. I'm also going to have a chat with John Lindeman, the researcher who's got some interesting thoughts on how long this particular property downturn is going to occur and why the property markets may pick up much sooner than many other people expect based on the research he's doing. And in my mindset moment, I'm going to share with you why the poor people love to hate success. So let's get on with the show. Around this time each year, it's customary for us in the property industry to peer into the future, look at our crystal balls, and attempt to predict what's ahead for our housing markets in the coming year. Look, while making such forecasts is clearly not an exact science, I can safely make 5 predictions that I'm certain are going to come true this year in 2019, and I want to share them with you now. First of all, my first prediction is that most predictions are going to be wrong. This is going to be a bad year for those in the prediction business. Now, I'm sure this is going to be correct, as most economic and property experts get it wrong, despite being armed with all the research, despite having all the information that one can get in today's information age. The problem is that while the fundamentals, things like population growth, supply and demand, employment levels, interest rates, affordability, inflationary pressures, those things are pretty easy to monitor. There's one overriding factor that the experts have difficulty quantifying, and that is investor sentiment. Currently, investor sentiment's low. In fact, it's the lowest I've seen in decades, despite the economic fundamentals being quite solid. I don't remember things being as bad since, I guess, the early 2000s in the recession we had to have. The second prediction I'm going to make is that many of the predictions for 2019 won't happen. And a lot of things will happen that none of the forecasters thought to include in their predictions, because market movements are far from an exact science. Every year there's an X factor, an unpredicted factor either locally or from abroad that impacts our markets, sometimes positively, sometimes negatively. However, when you look back in retrospect, those unexpected events, they come out obvious. They seem to be the consequences of the current economic and political environment. Last year, no one really predicted the full impact on the world of finance from the revelations that came out of the Haynes Royal Commission. That surprised a lot of us, didn't it? And no one seemed to predict the depth of the crisis in consumer confidence that would be brought about by the credit squeeze. Now, the third prediction I'm going to make is that a small number of the economic and property market forecasts for 2019 will actually come true. And, those who randomly predict them, they're going to claim to be experts, despite the fact that this was probably the first time that they got one of their hundreds of forecasts right, and despite the fact that they adjusted the forecasts along the way over the years to tune in what's going on. It's just like some of those who are saying, oh, I predicted Hobart, but they didn't mention all the other predictions that they said wrong. My fourth prediction is that most property investors are going to get it wrong this year. Now, this one is simple, because they always do. And I'm not talking about those who failed to take action this year. You know, those who won't get in the market, even though that will be a big mistake for some. Many years ago, I remember reading details from the Australian Housing and Urban Research Institute, which showed that 20% of those who do actually get into the property market as investors sell up within the first 12 months, and 50% of them sell up within the first 5 years. Those are clearly not going to gain the long-term wealth created by those who hold on to their properties in the long term. So that's my fourth prediction, that most property investors are going to get wrong, because they always do. And my last prediction that I'm sure is going to come true this year is those who get it right will do very well. But I guess that always happens also because they set themselves up for the years ahead. Those who invested during previous downturns, who saw the previous downturns as a counter-cyclical opportunity, they've consistently done well for themselves. They recognise that in these slower markets, there are opportunities to invest when others are afraid to do so. It's an opportunity to buy when there are more willing sellers. It's an opportunity to buy the right sort of property that you can hold in the long term at a price that you wouldn't have paid a year or so ago. However, not all investors who buy during the downturn are going to get it right. That's because you can't just buy any property and expect it to outperform in the long term. The key is to buy the right type of property in the right location. And at this stage of the cycle, correct asset selection will be even more critical than normal. You need to buy a property below its intrinsic value, and a property that's got a twist, something a bit special, something a bit unique about it, like the ability to add value. I think that's a great opportunity in this market because it's going to allow you to manufacture capital growth through renovations or development when there isn't going to be as much general capital growth. Ideally, you should be looking to purchase an investment-grade property in the inner and middle ring suburbs of the couple of major cities that are still doing nicely and well, or those that are going to do well at two big superstar cities in the long term, Melbourne and Sydney. These are going to be the sort of locations that have got a historical pattern of above average capital growth, regardless of the ups and downs of the cycle, because of the demographics, the people who live there, the people who've got higher disposable incomes. Of course, all the factors that underpin our already healthy economy are also going to help these areas. Things like the general economic growth that's still going on, the jobs growth, we're creating more jobs than we ever did before, our strong population growth, the shortage of the right type of property in the right locations, and the strong infrastructure spending that's happening at the state government and federal government level. They're all going to positively impact the right type of property. Okay. Time for a couple more predictions for 2019. The big factors that will affect our property market this year, in my mind, are going to be the availability of finance, consumer confidence, and the result of the federal election. If our property market slumps further this year, the Reserve Bank's got the ability to lower interest rates, and it's done that in the past. That's what it's always done when the market slows down. It lowers interest rates to push up the availability of finance, and that's the other thing that can happen. APRA can also loosen the screws and allow investors and home buyers to borrow more freely. If it gets it right and does that, then our property markets won't slump much. I can't see any indication for an interest rate rise like some of the media are talking about. Not this year, not next year. If anything, interest rates should fall. But I know from history that the Reserve Bank doesn't like to fiddle with interest rates in the months leading up to a federal election. Of course, any fallout from the Haynes Royal Commission into banking is further going to affect the bank's willingness to lend and possibly their need to lift interest rates out of cycle. So one of the big factors I mentioned is going to affect our property markets this year is the availability of finance, because as we've often said, property investments became a finance with some houses thrown in the middle. And the other two are sort of interlinked, consumer confidence and the results of the federal election. I can't see consumer confidence changing significantly until after the election due to the unknown future status of negative gearing and the capital gains tax. This means there's going to be further moderate price falls, especially in Melbourne and Sydney, and there are likely to be significant price falls in certain segments of the market, particularly the new and off-the-plan apartment markets, where people are just going to have difficulty settling, and there's going to be quite a fallout there. In the meantime, there are other markets, including Brisbane, Canberra and Hobart, that are going to keep rising in value. So as always, our property markets are fragmented. But there won't be a property crash. Despite all the doom and gloom we hear in the media, things won't fall into a heap. Now, why am I so confident about this? Because history's a great teacher, and history tells us that over time, the value of well-located properties always goes up, and investors who stay in the game for a long term always do well. Sure, there are periods where property values are flat or periods when they fall, but the skeptics who like to warn investors away from real estate in the fullness of history have always got it wrong. If you think back over time, the naysayers are out in force when the property market starts to slow down. I've been investing in property for well over 40 years now, and during that time, I've been warned about property crashes on numerous occasions. I remember back in 2010 to 12, when the Reserve Bank raised interest rates, they did that to slow the property markets down. Our market slumped. And people warned that this was the end of it for a long, long time. But then when rates were eventually lowered again, the property market picked up in about 2012. Think back just over a decade ago during the global financial crisis. It rocked the world, and many suggested property values in Australia were set to crash and we're all going to lose our jobs. The Reserve Bank lowered interest rates, the economy moved on, and of course none of those dire predictions eventuated. Back in 2004, the property markets in Melbourne and Sydney stalled due to high interest rates that peaked in late 2003. But look what's happened to property values in those cities since. Going back even further, 2000, there was a heap of negative press and worry about the impact of GST, which was being introduced in 2001. Everyone said, that was really going to mess up the value and price of new properties, and it was going to do all sorts of terrible things. People said this new tax was going to destroy our housing market. And I remember back to the early 90s when we had a recession we had to have, when interest rates peaked and the markets crashed. Everyone said that would be the end of property wealth. It would all be downhill from there. Boy, were they wrong. As you look back, it becomes clear that there's a cyclical pattern to our property markets, with the media and clever commentators offering lots of reasons not to invest. But the truth is, we have periods of prosperity and periods of slow growth and periods of falling property values. This has always been and will continue to be the case. So the big question is, what will 2019 bring your way in terms of wealth creation and property? Okay, here's one more prediction for you. Most people listening to this podcast will do nothing different in 2019 that they did in the past. And that's going to be a real pity. So I'm getting together with Dr. Andrew Wilson from My Housing Market and Ken Race to conduct my annual property and economic market updates in Melbourne, Sydney and Brisbane in March and April, where we're going to unpack all the figures, give you some predictions. And as I've been working on these presentations, clearly some of my thoughts have had to change. You have to change the set of your sails because the winds are blowing differently today. So if you don't change the set of your sails, you're going to be blown out of direction. So if people are still saying the same thing this year that they said a year or two ago, be careful. Maybe they haven't got a different perspective yet. They're too late, or they haven't got anything else to offer you. But we have no properties for sale. So go to propertymarketupdate.com.au, propertymarketupdate.com.au, and reserve a spot for yourself and a friend, because your friend can come for free. And I'd love to show you what our research is going to suggest in much, much more detail, how you can avoid the landmines and the traps, and how you can take advantage of the opportunities, because you are going to have to do things differently. My living off equity strategy has changed. The sort of properties we're buying a little bit different. They have to be. I look forward to catching up with you at the National Property Market Update. What you need to do is go to propertymarketupdate.com.au, find out all about these one-day trainings, and as a listener to my podcast, you can come for free when others are paying. Just put in the coupon code podcast and I'd love to see you there.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Have you noticed there are two types of people in this world? Those who hate the success of others and those who let the success of others fuel them towards their own greatness. Now, unfortunately, I found that most people fall into this first group. They don't like other people's successes. I guess that's why we call things the tall poppy syndrome, which is interestingly an Australian phenomenon. They don't see it overseas. They don't see it in the United States. So here's my free tip for you. Be in the second group. Be in that group of people who let the success of others fuel you to even higher greatness yourself. That's the way the rich think, while the poor revel in the failure of others. Some people look at other successes and failures as a way of validating their own greatness. They pick apart the reason why certain people achieve things, or they relish in a moment when others fail. Now, both of those paths lead to mediocrity. It's easy to spot those type of folks because they use words like luck. This is an ugly truth in life. There's a long list of people who'd rather complain than actually do something about it. And as for luck, I've always thought that hard work creates good luck. So take a quick assessment on how you respond to the success of others. Does it discourage you? Do you envy them? Don't allow yourself to be brought down by those hopeless emotions. Instead, allow other people's success to fuel your own fire. Let it allow you to achieve your own levels of greatness. If somebody else can do it, you can do it too. So today, pick out someone who's doing a great job, great work, compliment them for it. Muster up your sincerest praise and generously pour it out on somebody else. And the sooner you're able to recognise and praise greatness, the better chance you're going to have of replicating it. And when you succeed, know that some people will hate you for it. When you fail, some people are going to cheer. In fact, there's not a successful person out there who isn't in some way hated for their success. But the truly successful folks are the ones who can build something remarkable with the insults that are hurled their way. Have a think about that. That's the way to live your life. Revel in other people's successes and allow them to propel you to your own greatness. We all seem to hear and read lately how poorly our property markets are performing. Look, you don't have to look too far to find somebody who's suggesting the property markets this year are going to crash. Now, everyone's got an opinion on property. I guess there's 25 million property experts around Australia. However, very few have got a track record of that we should be listening to them. Now, somebody whose research I admire and whose opinions I listen to is John Lindeman of Linderman Reports. He's got well over a decade of experience researching the nature and dynamics of the various property cycles and property data, and John's widely respected as one of Australia's leading market analysts. I know I love reading his in-depth columns in Your Investment Property magazine every month, and he's always been a popular contributor to my Property Update, and he's written 2 great books on property investment. So welcome, John.
Well, welcome everybody, and thanks for having me along, Michael.
So today, John, I'd like to talk about our current markets, the downturn we're experiencing, and I'd like to get your thoughts on how long you think this phase of the market's going to last and when we can expect the next property upturn, because I think that's what many of us are holding out for. So, John, we know that there are many property pessimists expecting the current downturn to continue, and some are even suggesting a significant further downturn in our markets. So let's look back at history. How often have we experienced a significant downturn? We get the ups and downs of, 5, 10, even 15% happening each cycle, but the big ones, how often do they happen?
Well, there's only ever been 3. I've studied the performance of the housing market going right back to 1901. And from that, I've been able to work out quite accurately, how markets are likely to perform in the future. as well. But when we look back in time, there's really only ever been 3 periods of time when property market prices fell significantly. The first one was during the Great Depression, and we all know about that terrible time. And property prices fell by around 26%. But there's an interesting thing about that is it took 6 years for that fall to occur, from 1930 to 1936. And of course, after the Second World War, they trebled in just a few years. The second time was during the Menzies credit squeeze in the early 60s, when they fell from 1960 to 67 by about 18%. But then they shot up again in the decade following that, in the 70s. And the last fall, which was not that significant, was in the immediate outcome or the fallout of the GFC, when prices fell by around 8 to 10% from 2008 to 2012. But we all know what happened after that. Of course, they boomed in Sydney, Melbourne, and more recently in Hobart.
In the past, the finance industry, the banking industry wasn't as regulated, and there weren't as many controls, and the Reserve Bank didn't have the ability to control the economy as well. But looking back then, what precipitated those large property slumps in the past?
Well, in each case, the first thing that happened was a share market crash, because when there's some sort of economic or financial crisis, the share market is the first to react. So we had the Great Depression, the Great Wall Street crash of 1929, and then we had a number of years where wages, salaries fell, unemployment rose, and housing finance dried up. In fact, some banks went to the wall, including the State Bank of New South Wales in that Great Depression. So that's the series of events that tends to occur, and then that leads to a lack of housing finance, which then causes the housing prices to fall.
So today, it's very different. Look, most people won't remember, you and I are old enough to remember some of those crashes, the Great Recession we had to have in the early 90s and the stock market crash of 87. But I think most of our listeners are going to remember a decade ago, the global financial crisis, where countries were going broke, institutions were going bankrupt, and we were uncertain. We were in uncharted territories. It doesn't seem like we're in those sort of circumstances today, John.
Not at all. It's completely different. We've got a growing economy. We've got very low unemployment. We've got low interest rates and high population growth. And what amazes me is that all these doomsayers out there, and I heard another one the other day saying that price falls were likely to continue for another year, they don't tell us why they believe this, because they really don't know. They just think, they've gone up too much in Sydney and Melbourne, therefore they have to come down. Well, that's just complete rubbish.
That's not how markets work. You hinted at it before, that really a lot of it has to do with finance. So residential real estate investing is a game of finance with some houses thrown in the middle. When you and I were younger, a lot of it had to do with credit squeezes. I remember the old days of a credit squeeze. But since the regulation of banking, the Reserve Bank in the past has controlled the booms and the downturns by releasing credit in a different way, by lowering or raising interest rates. This time, we've actually had a more soft landing, a controlled landing with the macroprudential controls. I guess we are going through an old-fashioned credit squeeze again, aren't we? But when do you think things are going to start changing, John?
Well, I think the difference here is that the credit squeeze has been self-induced. It's actually the cut in housing finance is something which has not been caused by the economy or share market crash or wages, salaries aren't falling, unemployment isn't rising. What's going on is that the banks are responding to the possible fallout from the Royal Commission on Banking. They're tightening up their lending approval processes, showing the Commissioner just how stringent they really are. And I think it's like, if you can imagine a couple of bad boys at home and they've been playing up while mum and dad are away, and then suddenly they realise that mum and dad are about to come home, and they say, let's clean the house up, let's fix everything, because we'll make it really good, and then they won't get angry at us. So I think that simple illustration shows you what's going on right now, and that why, as soon as the Royal Commission is over and the banks have been suitably chastened, things will get back to normal, because housing lending is the bread and butter of what the banks do.
So I was interested to read your blog about that, where you were suggesting that maybe the downturn is going to finish sooner than some are expecting, and the next upturn isn't that far away, John.
Exactly right, Michael. And the reason for that is that we haven't really had a boom at all. People say, Sydney and Melbourne have boomed. Well, Sydney went up by about 70-80% in the last 5 years, and Melbourne a little bit less than that. Hobart went up 30%. But you see, this is all in the last 5 years up to, say, the middle of 2017. But if you look back over 10 years, you see that the first 5 years of that decade, there was no growth at all. So what we've experienced is virtually a doubling of house price over 10 years. And that's pretty much how the market performs over, if you look back to 1901, it's about 8.3% average growth per annum, which is a doubling every 10 years. So what we've seen is normal performance.
I think another lesson from what you just said is that you should take a long-term view on property, because in Australia, in capital cities in particular, it's changed over the past now that it's big capital cities where the property values are growing. In the long term, Melbourne and Sydney have done just over 8% growth per annum, and the other capital cities maybe a little bit less than that. So you've got to own the right assets and remain in the market for a long time. Now, John, you're well known for your research, and I know while many people still look at lagging indicators, things that have looking in the rear vision mirror, I know you look for leading indicators, things that are going to point to what's going to happen in the future. So what indicators do you monitor with your research, and what are they telling you?
Well, the main indicator is population growth. We've got one of the largest population growth rates in the world right now. And it's coming mainly from people arriving here from overseas. But there's a secondary effect, and that is also interstate migration. We're getting a lot of people moving from Perth and Adelaide to the eastern capital cities. Then when you look further at that more closely, what you see is that actually people are moving away from Sydney and they're going to Melbourne and Brisbane. So when I put all that together, what I see is that cities like Melbourne, an astonishingly high population growth rate of over 110,000 people arriving each year, and nearly 100,000 coming to Sydney. But then these are people coming from overseas. After a few years, what they do is they want to buy a property, and then I'm seeing that people are leaving Sydney and moving to Melbourne and to Brisbane because it's more affordable. Now, even if the government cuts back overseas migration rates, this has a lag effect of about 3 to 4 years, because when people come here, what do? They rent, and they have to rent for 3 or 4 years before they can buy. And it's when they buy, that's when you have a real impact on prices. Now that's going to continue for the next 3 or 4 years, even if overseas migration is cut. So you could see a lot of growth coming in future.
Now, it's not just population growth, but it's also household formation. And so a lot of the migrants, as you were suggesting, are in household formation age. And yes, for a year or two, they decide, I'm not sure where I'm going to live. I'm not sure where my jobs are. I'm not sure if the visa is going to work. So they rent. And then down the track, they end up buying. So that's a really good forward indicator. So I guess the bottom line from what we're suggesting, John, is that things aren't as bad as some of the property pessimists are making out. And in a short while, the Haynes Royal Commission is going to come out with its reports. We've got an election coming up later this year. And then I guess it's very likely life will get on with like normal again.
I definitely believe that will be the case. And I think the other significant things, apart from the fact that Sydney and Melbourne haven't really boomed as such over 10 years, they've done what is average, but the other capital cities haven't really moved at all. Now, we can understand why perhaps Perth and Adelaide haven't gone up a lot because of the population drain that's occurring. But what about Brisbane? It's got the highest rate of interstate migration, over 20,000 people arriving, and of course the same for Melbourne. So in the December issue of Your Investment Property, I actually talked about why I thought Brisbane was set to boom. And I also believe that there's no way that the housing price falls are going to continue into next year.
I agree with that. And Brisbane's not going to boom because it's its turn. People think, well, everything goes in rotation. And that's not exactly right, but it's because of the fundamentals. So we should be investing based on fundamentals as opposed to on media. So I know you've got some great reports, and I enjoy reading your commentary on Property Update. But if people want to find out more about you, they can go to lindermanreports.com.au. And I'm going to have a link to that in the show notes, just in case people can't remember that easily. lindermanreports.com.au. John, I really appreciate the time you've spent with us, giving us some insights. And let's catch up again real soon and talk a bit more about your predictions for 2019.
I'll look forward to that very much, and wish you all every success with your property investing in future. Thanks, Michael.
Well, we covered a lot in today's show, and 2019 is going to be a very interesting year, so it's going to be interesting to see how some of those predictions from me and John Lindeman pan out. I'm going to keep you regularly updated weekly with this podcast, but in between, I hope you get my daily newsletter. Go to propertyupdate.com.au, and when you subscribe, you're not only going to get my views, but those of Australia's leading property experts directly into your inbox every day. I've also got a couple of reviews I'd like to read out, and thank you so much for leaving the reviews. I love getting them, but it also tells other people that you're appreciating and enjoying it. So when you do leave a review, if I read them out and you email me at michael@metropole.com.au, I'll gift you one of my books. I'd love you to pass the message on to your friends, your colleagues through Twitter, Facebook, to the share button, whatever, because it's going to be a challenging year. So my aim is to help you get through it, and I'd like you to help others by letting them know about this podcast. But I got a review, a 5-star review from Stephen CC3, who said, "Hi Michael, thanks for sharing your knowledge. The information is very valuable and timeless, and it helps people keep things in perspective." Well, I hope today's show did, Stephen. And he went on to say, "You call it as it is and your achievements speak for themselves. There'll never again be anyone like you. Lucky to find you, Stephen." Well, gee, they're really nice words. There are lots of other good people out there as well, but my wife thinks I'm special, and I'm glad you do as well. And Austin Gann wrote, "Thanks, Michael, for spending your valuable time on your podcast educating people on property investing. Every person who is involved in property should listen to this. Very informative and unbiased, and like typical media news, that reports only half the truth." Well, thanks for both your lovely messages, Stephen and Austin, and I look forward to speaking with you again next week for the Michael Yardney podcast.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.